Hey folks, Andrew Miller here, the Mortgage Man with the Mortgage Man team, powered by Thrive Mortgage. Bringing you a guide today on rate buydowns. This is a term that has been going around for the last couple of years, well, pretty much ever since interest rates started going up. This is a strategy that we as lenders use to make housing more affordable for our clients. So I'd like to go over some pros and cons and kind of a description of what these buydowns are. So a buydown is a way for a borrower to obtain a lower interest rate by paying discount points or a fee at closing. It's also known as prepaid interest. A question I get a lot is, does it work for all loans? Well, pretty much it does. Here are the 5 biggest ones that you're all familiar with: VA loans, FHA loans, ARMs, jumbo and conventional mortgages. 2 main types of buydowns. There's a temporary buydown. The biggest one typically is a 2-1 buydown, and there's your permanent buydown. Your temporary buydowns is when you pay a fee at closing for a lower interest rate temporarily. Typically, that's usually a 2-year scenario where your interest rate is 2% lower for the first 12 months, 1% lower for the following 12 months, and then on year 3 to the loan maturity is at the market rate. Permanent buydowns are not as drastic, so you don't see as low of an interest rate drop on those as you do with the temporary buydowns, but they are for the life of the loan. Again, 2-1 buydowns are pretty much the most popular. There also is a 1-1 buydown and a 3-2-1 buydown. So for instance, on a temporary rate buydown, say you qualify at a 7% interest rate to start with. Well, in a 2-1 buydown scenario, your first year, for the first 12 months worth of payments, that 7% interest rate would actually be a 5% interest rate. Month 13 through month 24, the 7% rate then becomes a 6% rate. And then for the life of the loan, you would be paying the 7% interest rate. And the mentality behind this strategy is a couple things. Either A, as time goes on, you're making more money at your employer, or B, you're giving yourself time for interest rates to come down. Permanent rate buydown is another great option. You don't see as drastic of a rate reduction in this scenario, but it is fixed for the life of the loan. So for instance, typically a good rule of thumb is if you buy 1 discount point, which is equal to 1% of the loan amount that you're borrowing, in exchange for that prepaid interest, you're going to receive an interest rate that's about 1/4% lower than what you would typically qualify for. Pros and cons for temporary buydowns. Pro is it's a much lower rate typically, but it can be a little bit more expensive. You cannot qualify at the start rate. It is kind of a con there, and it's only temporarily. And then obviously when interest rates drop, you would have to refinance, but that's something that we are offering for all of our clients without any lender fees, provided you purchase your home with us. It's called our rate reset program. Pros and cons for permanent rate buydowns. The rate is fixed for the life of the loan. You can qualify at the lower interest rate that we buy it down for you. There really isn't much of a need to refinance down the road unless the interest rates drop substantially and are obviously going to be less than what your buydown rate is. And then a con, really the only con here is if the rates do drop enough to warrant a refinance. That's something you would need to do. But again, we use our rate reset program for that and waive our lender fees for your refinance. So this is really, these options, again, came around the last couple of years when interest rates went higher, and it's a great strategy to make housing a lot more affordable for everybody. So if you'd like to learn more about these programs, please give us a call at 704-231-3991, or you can visit us online at carolinamortgageman.com. Click on our resources tab, and we have lots of videos out there for you. Look forward to talking to you guys soon. Thanks.